So hello, my name's David Andolfatto. I'm with the research division here at the Federal Reserve Bank of St. Louis, and we're here at the 39th Annual Fall Conference. We're very happy to have Mark Bils here at the University of Rochester, who gave a talk yesterday, in fact, with the title, Resurrecting the Role of the Product Market Wedge in Recessions. Thank you for being here,
Thanks,
Mark.
David.
And I was wondering if you could just tell us a little bit about what your paper's about, what the question is.
Yep, in the papers with Pete Klenow and Ben Malin, and anything I say shouldn't be attributed or held against them. So,
Okay.
But yeah. So the starting point is well known that we don't really understand what happens in recessions. So in recessions, there's a big drop in employment and hours. At the same time, consumption drops a lot. So given the drop in consumption and that people hours in employment are low, we would expect, and I think it's reasonable to expect, that people would be willing to work at a lower rate of pay. So the reservation wage for workers, what they require to work, should be low. At the same time, you could explain that if productivity dropped a lot, but that really hasn't been true. For most recessions, productivity doesn't fall that much. For the last 3 recessions, which is the period we look at, the last 25 years, really there's, on average, labor productivity doesn't really drop. So then you have this puzzle. Why is it that people are getting laid off, or that firms aren't creating jobs, or the work weeks are cut, even though it looks like the return on the labor doesn't look bad. The productivity looks, pretty good given what people would want to work at. So that's referred to as the labor wedge. It shows up in other places in the literature. The whole unemployment puzzle, sometimes called the Scheimer puzzle, is very closely related. So that's our starting point. And then in the literature, a lot of that has been stressed as a problem from the labor market. It's natural because you're trying to understand why labor drops so much in recession. So it's viewed as, what's the problem with the labor market? And so people have looked at average hourly earnings in the data and say, well, average hourly earnings also don't fall that much during recessions compared, falls maybe a little bit compared to productivity, but not so much. So maybe the problem is in the labor market, what's keeping the wages sticky or not falling. Mm-hmm. So we make a couple of points. One is just as a way of motivation is we don't really know how to measure what the price of labor does in recessions, because we know that firms smooth people's wages. New hires' wages drop a lot more, and so for various measures of saying what's really the price to of firms of asking more hours from their workers or to hire somebody in recession, we would argue it's very reasonable to think it drops quite a bit.
So let's be careful. So you mean by that, the price of labor to the firm may not be fully reflected in the wage that they're earning at that
Right.
point.
So I suppose I don't cut all the wages for my long-term employees.
Yes.
As a way to kind of, for convenience or to try to provide some insurance for them. That doesn't mean that I can't go out and find somebody at the new who would be cheaper, for instance. Right. So we show that for various different ways of measuring the price of labor, that you could get that there is quite a drop in the price of labor compared to the productivity. So that looks like the problem is not sort of wage stickiness, but just that the demand for labor really is dropping a lot in recessions, but just not in a way that we can link to productivity. And then so what we show then is in a few different ways is if we look at lots of inputs that don't get purchased through the labor market, we see very much the same phenomena. So I'll just mention a couple, but we look at like self-employed workers and we see very much similar phenomena, even though of course they're not, they don't have any bargaining problems with their employers. They're self-employed for themselves.
Right.
And we look at other intermediates. And intermediate purchases are huge in most industries. It's like half of the value of their output. And we see there that the price of the intermediates drops a lot, and yet the inputs drop a lot. And we see the same puzzle that the firms seem to be pulling back a lot on intermediates, even though the productivity looks quite good. So we're basically arguing it's not sort of a problem in terms of the wage setting in the labor market. It's a more general problem of firms sort of drawing back and being more reticent to put output out on the market in recessions, and it's just causing all factor demands to drop. So
very good. So before I go on with that, I just want to step back a bit and just the statement that labor productivity seems to be relatively stable in the downturn. Right. This is a statement about the average An average, the
That's
average
about
product.
an average,
There
yes.
are some people who've claimed that there's some sort of composition bias in the sense that, I mean, the type of workers you see laid off in a recession are the less skilled, lower productive workers. And as these workers are laid off, this raises the average labor productivity of the people who keep the jobs. I mean, do you have any view on that?
Yeah, no, you can calculate sort of how big that is, and that helps to explain a little bit. You can you can just do sort of a back of the envelope calculation. Okay. You go into in a recession, for every % fall in hours, maybe 3/4 of that is employment. The guys who are getting laid off, or maybe they're 20% less productive, and then you can calculate. It makes a little bit of difference.
But no.
I can do other calculations though that would suggest that productivity actually drops even less in recession. So if I have any overhead labor, any overhead factors, the fact that I have to kind of keep them on in the recession would tend to cause productivity to drop even more. So these things tend, I think, kind of offset. But
Okay.
I agree with what you're saying, but I don't.
The quantitatively
Quantitatively,
not
I
important.
don't think it's. And of course, it won't show up for these other factors we're looking at, like the intermediates and things like that.
So, your findings, Ed, would call into question these approaches to trying to understand recessions that kind of focus on problems in the labor market frictions, things like this, and move the focus someplace else. Like what?
Well,
where?
I would say it a little differently.
Okay.
We would like to say that the focus shouldn't be only on that.
Okay.
I wouldn't argue that there aren't some
Right.
distortions coming from the labor market and sort of from the goods market. It's just, I think the literature's moved to say it's almost all in the labor market, and it's largely based on looking at like average hourly earnings.
Right.
And we would just say, look, in fact, we say this literally, we think both what's happening to other inputs in the goods market deserves attention in the same way that the labor market does.
So how would you like to see, I mean, do you have any like pet hypotheses here? What's going on in the product market?
Yeah, well, so let me just say again what we see, and then what some possible explanations for that. So what we're seeing, and this came up at dinner last night, but we see that the productivity of factors doesn't seem to be dropping. Productivity is not dropping so sharply in recessions, but the cost of a lot of inputs seem to be falling. So what could that be? Well, one natural story would be that the firms are raising their markups during recession. So they're pricing, they're pulling back and they're pricing higher. That shows up in Keynesian sticky price models, just because the prices are slow to respond. I think these effects are sort of bigger and longer than it would be hard to get out of that sort of a story, in particular particularly big for the Great Recession. So we see this for all three recessions, but what I'm talking about, this markup, this product market wedge, particularly for the Great Recession, and it's really striking in like 2009. It's still continuing on. So it could be sort of price stickiness. It could be that firms are just sort of purposely, they feel like it's not a time where if you try to keep producing it the same way you were, you'd have to slash prices so much that they just have to draw back in. I discussed a paper by some authors from BU who talked about a customer market where, because of the borrowing cost went up, especially after Lehman Brothers, that they saw that the firms that had cash flow problems, they raised their price relative to the other guys, and their explanation was that firms didn't want to invest. They had to get money now, so they had to charge a higher price, even if it cost them some of their customer base. They didn't want to do it, but it's just a form of cutting investment. And I would say more generally, a lot of any decision at the margin to produce more is partly an investment. So when a firm hires a worker, it's always partly an investment.
Sure.
You don't know whether they're going to be good or bad. If you really were just hiring based on that day, would you ever hire these guys? They might likely come in and screw things up for the day as much, right? So there's always an investment component to producing more. So anything which is going to cause you to have less investment could show up as like, well, I'm going to be more reticent to produce in the recession, and that will show up through moving up a demand curve, a higher price. So these things will kind of look alike. I mentioned, I would mention a paper by Ariano and Yambai and Kehoe for instance, which is another avenue which says if uncertainty goes up in a recession or risk aversion goes up,
Yes.
and you don't want to get overextended because you're afraid that if you get overextended, you might go under and you might lose the whole thing. That's another reason why you might be more reticent and kind of pull back in a recession. So I kind of like this. All these things will kind of lead to a sort of a less dynamic, less competitive market in a recession. I think it could cause, markups to go up, but they kind of come from different forces. And to be honest, I mean, that's kind of I think that's what we're arguing, is that people should be focused on these other forces as well. But it's not that I can tell you which is the right.
But in any case, it does seem to rule out some forces, like productivity shocks or stuff like this.
Well, I mean, that's the data on productivity are do what they do. So they're speaking to that. It's hard. It's always been hard to to get a huge amount of action on. It doesn't mean there's no role for them, but there has to be, I think, other shocks that are moving around. I'm going to focus on labor, but all these factor demands. The firms are not wanting to hire. I can't rationalize it all with a productivity shock, because the productivity just doesn't fall enough unless we think that workers really aren't sort of willing to take a lower pay in the recessions. And I think that's a very hard story to push. Yeah.
Well, very good. In terms of, your paper might be far away from actually, you don't make any explicit policy recommendations on your findings and stuff like that. But do you see how your line of work, your line of inquiry might one day kind of inform policymakers in a particular manner? Or is it too kind of removed from that right now?
I get, and then anything here, particularly not speaking for Pete or Ben, of course, but I don't think in terms of policy, but you do want to know. I would say the following, and this came out in the last thing we're saying. We're saying we don't know what's causing labor to fall. We don't think it's just wage stickiness. It could be these things we don't really understand very well. So I think when we recognize that we don't understand recessions, that has important policy implications that you should tread lightly and carefully, right?
All right.
So that would be the one lesson I would take. I wouldn't take a view from the recessions that the labor market just doesn't work at all, so it's open to all sorts of escapades and innovations in policy. And I would take that, there is a general point that, what goes back, it's not really specific to our paper, but looking at this sort of the fact that it looks like inputs have a low cost rather than productivity, that this cycle, recessions are costing sort of this inefficiencies. So you could take from, that just reinforces the notion that there are costs to these recessions, but then what's the right policy response? Well, I can sit here and I could say, well, we should do things, therefore, where we try to subsidize activity more in recessions. But sometimes that's counterproductive. So if I look at policies that get made on the, not according to rules, but ex post, sometimes they make things worse. So they create activities where you don't know what to do as an employer or a firm, because you're trying to, even though you're not necessarily in the rent-seeking business, in those times you sort of have to be. So I can give two examples. So you're sitting and we're in a recession, and you know that maybe we'll get a big increase in investment tax credit, maybe we won't. Maybe it'll come next year. So what should I do? I should invest less so that I will delay my investment to when I know there's the investment tax credit. During the last, especially around 2009, there was a lot of discussion of creating a hiring, a subsidy to hiring, so that firms did net hiring, you would get a payment from the government. They were speculating on this in the administration. This is a terrible idea. What you're basically doing now is firms have to sit around and try to anticipate. I don't want to hire now, because if I hire now, then I'll be punished in the sense if I hire later, I won't get this. I won't get this subsidy. So I think it's, even though these recessions look very inefficient, I think you have to be careful of not. The lesson I would take is don't make it worse, or use a rule. If you had a rule, if you could credibly have a rule that we're going to, when the employment rate falls somewhere, we're going to have a investment tax credit, we're going to have some payroll tax cut, and the policymakers could credibly stay with that. I think you could rationalize that. But if you can't, if a policymaker can't tell you what they would do in some state of the world in terms of these sort of policies, then I don't think you should let them, trust them to make choices after the fact on these sort of policies. So that would be my view, but again, not probably Pete's and Ben's.
I understand. No, that was excellent. Thank you. Very good. So if could you offer a couple of concluding sentences, a takeaway, 2 or 3 sentences summarizing kind of the main goal of your work or the outcome, lesson?
Yeah, well,
Apart from
the
what
lesson,
you just,
I'm going to say the lesson.
Reiterate what you just said.
Yeah, the lesson is the recessions look quite costly. It looks like the labor market, but all markets have some sort of a distortion, which is really pulling in inputs relative to productivity, and we see it. We think we see it in lots of. It wouldn't have to be true in every recession. I don't think it's true to the same extent in each recession, but in recent recessions, and particularly the Great Recession, it looks like it's sort of hit all factors, and that's what we think of as a product market distortion that's affecting all inputs in recessions.
Very good. Thank you, Mark.
Thanks, David.